Good day, fellow investors. I hope you're fine, as today we'll discuss target date retirement funds. I'll explain what are target retirement funds, how they work, and what are the issues, so you can see if that is something for you or you prefer something else. Let's start with what is a target retirement fund. Common investing sense and the prevalent advice for retirement is that when you are young, most of your investments should be towards stocks. Then, before retiring, you should transition to a larger percentage of bonds in your portfolio so that you can create steady income. And then, when you retire, have just a small amount in stocks and then more in bonds. Now, this has been the prevailing investing wisdom related to retirement for the past 20-30 years, since we started really talking about retirement and investing. Okay, you might think stocks, then bonds, yields, looks okay. Yes, the complete idea behind it is very good, but it is mechanical. It doesn't think and it doesn't adjust itself to the present situation on the markets. Let me explain. Now, the first issue is derived from valuations. Currently, valuations are at historical highs. This means that longer-term returns will be very low. Now, the cyclically adjusted price-earnings level for the S&P 500 is around 30, which is at extreme historical lows. At such valuation levels, historical 15-year forward returns have never been above 5% for the S&P 500 and have often been below 0% for the next 15 years. So if you invest now in a target retirement fund and you're young, you know that your 15-year returns will be below 5% definitely, and there is high probability that they will be below 0. But common advice says let's invest everything in stocks now. So, something to think about. On the other hand, when the cyclically adjusted price-earnings ratio was below 10, then returns were always above 10% in the next 15 years. So if we go back to the first picture, so you invest now in stocks and you're expected to hold them for a period of 10, 15, 20 years. But at current valuations, those returns will be negative. And at some point, stocks will be very cheap. But as you have a programmed portfolio allocations, sooner or later you start selling those stocks. So if you buy them now high, with programmed selling in order to buy bonds, there is a high probability that you will buy them high now and sell them low later, which is crazy. And this leads me to the second issue I have with target retirement funds, which is why should you sell stocks and buy bonds? Let me elaborate on that. Warren Buffett would say, my preferred time period for holding a stock is forever. Now, if Warren Buffett wants to hold a stock forever and he never liked bonds, why would you, when you're about to retire, you have held stocks for 15-20 years, why would you start selling them now when those companies continue to grow, evolve, higher earnings, higher dividends, everything is doing well, and especially if you bought companies a long time ago, those are bigger and bigger. And you now start selling them as you get closer to retirement in order to have a lot of bonds. For those younger, the current dividend yield of the S&P 500 is 2%. The current yield on treasuries, 10-year treasuries, is 2.3%. Current inflation is 2%. So if you invest in treasuries, your yield will be in line with inflation. If inflation goes up, you will be losing money every year. So I don't know why you would allocate your investments to bonds now. So again, programmed, planned is okay, but just look at the fact. However, if we look at what will happen with the S&P 500 dividend, then you can see that the S&P 500 dividend has been growing over time. Since 10 years ago, it has grown 44%. The last 20 years, it is a double. If you want higher yields, please check my video of Berkshire Hathaway versus the S&P 500. or my video on another Buffett's purchase, store capital REITs. Going back to why would you sell stocks? So let's say you're young, you buy now a good company with a good earnings, with good growth, with good management, and that company continues to evolve in the future. It has in a good sector, it has a moat around it, grow its dividend. Why would you sell and go into bonds that don't even cover for inflation? I'll show you here an example on Southern Company, a utility, and it has been increasing its dividend for the past 15 years. The current dividend is $2.32, yielding 4.72%, and as earnings are expected to grow by 5% per year, you can expect a continuation in the presented dividend growth pattern. If the dividend grows by 5% per year, your yearly yield on investment would be 10% after 14 years and 20% on your initial investment after 28 years. So when you hold a stock, your yield on your initial investment will continuously grow. When you hold a bond that doesn't cover for inflation, your yield will be zero, no growth, and you will be losing money. Why would you want to retire and lose money? So think about this before you invest in target retirement date funds. Also much better than index funds are companies like the Southern Company I just discussed, Berkshire Hathaway, Hine, Store Capital. If you want good buy and forget companies. If you want more riskier companies where you have to know what you're doing and look what's going on and follow what I speak on this channel, then check my favorite stock picks. Thank you very much for watching. Please ask questions, comment, share your thoughts, and I'll see you in the next video.